Hi, Chapter 4 Overview with hints to follow. We're going to talk about the balance sheet and the statement of changes in retained earnings, or also called stockholders' equity. So the balance sheet shows the financial position of the company at a certain point in time. It's also called the statement of financial position. This brings up the accounting equation: assets equal liabilities plus owner's equity. This is the starting point for your financial statements. Uh, the assets, liabilities, and owner's liability are also considered the elements of the balance sheet. They are always recorded at historic costs, which means the cost that you bought them at. That follows them throughout. What happens, or what we use a balance sheet for, is to look for the liquidity or the nearness of cash, how quickly we can sell short-term assets to be paid to pay for bills, the financial flexibility, the ability to use the resources to adapt to changes if there's a change in climate, economic climate. The other thing is we look at it to see if they can maintain their presence or if this is a viable, sustainable business. And basically, there's a lot of equations that come out of the um, elements of the balance sheet. There are some limitations to this, though, and there's quite a bit of controversy about the historic cost valuation. What do we do with markets when it goes up or even when it goes down? How do you reflect that? Many of you know you can mark something down, but you can't mark it up. Is that a fair evaluation? It's a question we have to ask. Not all assets and liabilities are listed. How about Microsoft and Bill Gates? You know, how do you put a value on Bill Gates or Steve Jobs or uh, an engineer that for Ford that created the Mustang? So, you know, that all the liabilities are not listed. So that becomes an issue. You really have to dig to really know what is valuable. And some of the amounts are based on estimates. It makes a lot of people nervous, such as we estimate the salvage value. We estimate allowance for doubtful accounts, many things that we estimate. If we miss that estimation, then our statements aren't right. It doesn't look at periods of inflation. They're not noted, or changes in purchasing power. And sometimes it's hard to compare fair value when it's used because not all companies use it the same. So, you know, balance sheet is a good overall reflection of the company. It does have limitations. Please remember that. So there are also other statements and other disclosures that need to be put forth for your financial statements. One of them is a statement of changes in stockholders' equity, and its purpose is to show the changes in stockholder equity, and by that we mean capital stock, preferred stock, anything that's in that equity area. And this is done by using a schedule or notes to the financial statement. The intent is to help report on the changes in the financial structure of the company to help users assess that flexibility that we're talking about up here. Whoops. Let's undo that. Let's make that go back. So this is a kind of a very important part of your financials, so it needs to be disclosed. And it will show investments by the owners. It will show just which would be buying more stock, distribution to the owners, which would be dividends that are paid, and it will show the changes in retained earnings with net income and comprehensive income. We're going to do a little bit of all of this, and we're also going to discuss notes and disclosures to the financial statements. GAP has some fairly specific things that it would like to have disclosed other than just the numbers. So that is the overview. And now we're going to move on to the hints, which you're going to find in the hints from your instructor found in the assignments to be completed. Thank you.